Hello, everyone, and welcome to the TIMIA Capital Ask Me Anything with Monique Morden. Quick review of our agenda today. So I'm going to give you a little background about TIMIA, introduce Monique Morden, our new president. She will give you a quick update on what we're seeing in the fundraising climate for entrepreneurs at the moment. And we'll jump into some Ask Me Anything. So if you guys have any questions, please go ahead and throw those into the Q&A panel. Monique and I can both see them. And I will facilitate the webinar. So as questions come in, I'll ask Monique. If you have any follow-up questions, go ahead once again in the Q&A panel. If there's not a bunch to get going with, as we get to that section, I have a poll with a handful of questions that we get. We have been seeing a lot of in the last 3 months. So we typically talk to anywhere between like 40 and 80 entrepreneurs on a monthly basis. So we get quite a lot of these questions. So we've highlighted kind of the top 3 to 5 questions we get often. So I'll throw that poll out if we don't get some unique questions here. So the first thing I want to start off with is introducing Monique. So Monique recently joined us as president of TIMIA Capital. She came from a long history of being an entrepreneur, an angel investor, and an advisor to many different technology startups, particularly actually in fintech. Previous to TIMIA, she was the founder and CEO of JUDI.AI, and we're very pleased to have her bring her experience and her knowledge to TIMIA Capital. So Monique, over to you.
Yeah, good to be here and happy to be part of the TIMIA team, which part of the reason I joined was because of the team. Really strong from tip to tail in terms of marketing, origination, the underwriting, and the portfolio management. So yeah, I do like to think that I bring the entrepreneur sort of spirit to it. I've got a lot of empathy for the entrepreneurs that are there. But I also say it's really important when you're an entrepreneur to have passion and optimism, but you also need a strong dose of reality. So I think that's something that we bring to the table when we're talking to our entrepreneurs and trying to help them with their plan for the next 1, 2, 3 years and the next milestone that they're going to. So if people have more questions about that, definitely feel free to ask me anything about my background. Getting to know TIMIA, Mark, as part of the heading up the marketing, has this buttoned down and has done a lot of great work over the years of really sort of saying what box we're in. So I'm going to let you do the refresher on TIMIA, Mark, and who we are and who we serve.
Thanks, Monique. Yeah, so TIMIA Capital, we provide debt capital to growing recurring revenue software companies. So typically what that looks like is $1 to $7 million, a check of $1 to $7 million to a company doing somewhere between 2 and 20 million of annual recurring revenue. And what it's meant for is growth. So we think that if you're an entrepreneur and you believe in your company and you have a flywheel that is running, that if you add more fuel to that, you will get a larger return on investment than we can. So you can take our capital, invest it into your business, and see an outsized return on your investment with debt. So you grow your business, let's say 2 times, 3 times, 4 times over the course of 2 to 5 years. We take a small percentage, and because it's debt, you remain in control of your company. And you don't dilute yourself. You don't have to raise equity to do that. So you keep control and ownership of your business, and you see a larger outsized effect of that. So we strongly believe in that. And we've worked very, very hard over the last 7, 8 years to find better ways of helping entrepreneurs to grow their businesses while staying out of the way. So our current product that we have that we feel is a strong position in the market is a term loan. So what that is, it's a fixed interest rate, fixed payment loan from 2 to 5 years. And that enables you to have clarity on what's going on and transparency so that we stay out of your way. Your payments aren't intrusive to the business. You grow your business and then pay us back and you're on your way. So that is very quickly how TIMIA works. With that being said, it has been quite a difficult or different experience the last, let's say, 6 to 9 months as an entrepreneur if you're fundraising. Not only have valuations come way down, we've also seen things like Silicon Valley Bank going through some troubled times. So there's quite a lot of uncertainty for raising capital. Monique, do you have any comments that you want to make specifically around that, what you are seeing at this moment in the market?
Yeah, I mean, I'm always talking to partners and anyone about this as we're all trying to read the tea leaves and, see where things are now and where it's going. So definitely venture capital has dried up. There's still a lot of what they call dry powder. So the VCs are going to be supporting the high performers in their portfolio. They're still going to be, funding them and making sure that they're successful. The startups that have been funded by a VC but aren't performing so well, they're not going to be getting much love. And the middle ones, I think, are going to have to tighten their belt and sort of get their financial house in order. And that's really been the message to all startups, I would say, over the past 9 months, starting about halfway through 2022, there was a real message out there that this was coming in terms of on the venture capital, that it was going to start to dry up because it was very frothy. Valuations were coming down, but threats of a recession and, what was going to happen. And we did see that sales were softer for a lot of our existing portfolio and people that were applying. And if you didn't get your OpEx down and get your finances in order, it became harder. You'd had to do it eventually. So we were seeing that, in the market. Now, like Q1 hasn't been, everyone was holding their breath. I kind of felt like in January, people were holding their breath, but sales seem to be coming in again, both with our portfolio when we look at applicants. And we're getting some really strong applications. The quality of our applications coming through is actually stronger. And I think that's because venture debt is an excellent alternative to venture capital. Now, there's not as much out there for venture debt as there was venture capital. It's a huge hole to fill. And then with SVB, it's an even bigger hole to fill. So I think supply is still going to be limited. But demand is up. So depending on what type of startup you are, if you have some revenue and then if your financials, if you've managed your burn, you're probably, going to be well positioned to get some venture debt and or venture capital when it gets to the valuations that you're comfortable or sort of looking for. But from what I'm hearing, that's still going to be, 12 to 24 months where the idea is that, as you mentioned, valuations are down, that they're going to sort of creep back up, not to the sort of frothy level of 2021, but back to they're quite depressed values right now. So especially for those sort of mid-sized startups where you've done a bigger raise and you're looking to do your next raise and you don't want to do a flat or a down round, you're going to have to wait this out. And venture debt can be a way to sort of do that. So it's not, it's not doom and gloom, but I think startups need some real strategy to get through these next 12 to 24 months and how they're going to manage that and still hit their milestones that they're hoping to hit.
Yeah, agreed. Thanks, Monique. Just a reminder to the attendees, this is an Ask Me Anything. So if you have any questions, please throw them in the Q&A. We don't yet have any questions in there, but I thought, Monique, this would be a good opportunity for people to consider, what they're looking for from us and what we're seeing. Like you said, Monique, we see a lot from our portfolio companies, our 35, 40 portfolio companies, but also from the entrepreneurs that we talk to daily. We see a large mix. So I thought would be helpful to actually just go over like not only where we sit, but the different types of debt that you can access. So I'm going to share my screen here quickly, and I'll start, Monique, where you left off talking about venture debt. And if those of you attendees want to throw in some questions, please go ahead and do so. So to your point, Monique, you were talking about, like, let's take Silicon Valley Bank, for example. When you're talking about SVB, a lot of what's weird about this market and where we're in, and even for me personally, when I started with TIMIA, I was not an expert in the debt space, and I've definitely learned a significant amount over the past 5 years. And there's so many different types of debt that you can access. Venture debt, just to clarify, requires a sponsor. And so, and I'll explain what that is. So Silicon Valley Bank, the venture debt product that they had, relied on an equity investment from a reputable venture capitalist. So what would happen is you would go to, let's say, Andreessen Horowitz, Sequoia, et cetera, and land that Series A or Series B. You would probably go put that cash into Silicon Valley Bank. Now, regardless of whether you do that or not, you could go to Silicon Valley Bank and say, hey, I just got an equity raise from a known trusted venture capitalist. Can I have some debt? And so Silicon Valley Bank would kind of sit in between this senior debt and junior subordinated debt. So you could go get a line of credit for sometimes up to 1x, and in really strong times 2x ARR of a line of credit from Silicon Valley Bank, but that had to be guaranteed by your venture capitalist. So that's what venture debt really is. And I've heard that they were sending out rates of anywhere between 4% a year, sometimes as high as, let's say, 8%. So they kind of fit somewhere in the middle here. So let's just talk about this very quickly. When we are looking at a debt stack, we often see companies that have many of these. So they'll have a senior piece of debt, whether that's a line of credit or whether it's a term loan or similar from a regular bank. So a real bank. So that we're based in Canada, but we do a lot of deals in the United States. So perhaps it's a CIBC, but maybe it's a Chase, maybe it's a Bank of America. Your average big bank that you know. So they'll often want to be in first position, and they will have covenants on their loans, on their products, and they'll have quite an attractive rate, 4 to 6%. After that, you'll see where TIMIA Capital sits. So we call this junior debt. We sometimes will call this subordinated debt. And what that means is we sit below your big bank, but we cost a little bit more because the big bank gets the first pass. So if anything happens to the company, they get their money back first. And the company providing the debt in second position has a little less control over what happens if something goes wrong. What's interesting about this position, though, is we can actually subordinate. So what that means is we don't require first position, whereas some of our competitors do require that first position. And because of that, you can actually mix these. So if you have a good quality company and you have growth, if you have a, let's say, quite healthy monthly recurring revenue, you can go get a piece of senior debt and junior debt. And when you layer it together, you can actually lower your overall cost of capital in terms of debt stack. Then we get into the hybrid debt instruments, and a lot of people will know this as a convertible note. You can also, what's been popular, Y Combinator has made this very popular, a safe note. So that gives the option to convert that equity into debt. Then moving down the cost of capital chart here, then you get into short-term loans. In the heyday of the 2020s, it was very popular to go get something that we have seen and we call a merchant cash advance. So basically you plug in your accounting into a company like Clearco. They'll see what your marketing and sales spend is, or they'll see what your monthly recurring revenue is, and they'll give you a loan of, let's say, 3 to 6 months of cash. But typically they have really short payback periods. So 6 months, 12 months, 18 months. And what's interesting about those is, yeah, you get access to cash really, really quickly, but you also have to pay it back really quickly. So your principal payments are quite aggressive because you're paying it back in a very short amount of time. Then lastly, the two that are more equity related is the preferred and common stockholders. So common being your founders, CEOs, or early stage, maybe friends and family round, and then preferred, you're talking about your seed round, angel investments, and your venture capitalists. And the way that we look at this is we take, let's say you go do a venture capital round. So you raise a Series A. So let's say you take $2, $3, $4 million from a venture capitalist. When you take that money, you have to pay it back. So just like debt, you can calculate your effective rate of return because when you may not, as the founder and CEO of the company, actually have to write a check to that venture capitalist, but the company will need to go through an exit at some point to pay back that capital. And so what we do is we look at what those venture capitalists are looking to pay their investors. So they'll have limited partners and they'll have a target, typically that is 25 to 45% a year. And they're looking for 1 to 2 out of their 10 to 15 companies to have a large outsized effect of all their portfolio. And we calculate that the annual rate of return is roughly 25 to 45%. So that is kind of how we see the cost of capital in a startup, in a recurring revenue technology company. So that's kind of where we fit. We fit it in this spot up here, where we're not looking for a substantial amount of return. We're not a venture capitalist, but we're also not being really, really strict on the capital that you take from us. So we're not in the senior debt position with the low cost of capital. Monique, any comments, questions?
No, I really love this. I think when you guys first started talking about kind of, the cost of capital for equity, I know I had come with the founder view of like, well, no, you get 2 million and 10 million or whatever your round is, right? And there is that culture of like, hey, what a great win, and you've gone and you've raised this money. But it's true, what you don't realize is when you get to the end and when you're doing an exit, and of course everyone wants to be a unicorn or have a big exit, but by the time you do the waterfall of what the founders are going to reap from that, often they're hardly getting anything because of especially the preferred stockholders who get the majority of it and everything else that's in there. So I really love this image and how you walked through it all. And it's just a different way, like in your personal life, if you're thinking about going out and getting a loan and, a mortgage, and you're looking at the interest rate, it's different. And I think that's, kind of how, especially first-time founders, I know when I was going through, sort of looked at it like, oh, that's ridiculous. Like, why would you pay that interest rate? And then you realize once I exited, and which it's great to have an exit, any sort of exit is good. but where you're like, okay, I'm not getting as much as I thought I was because of, all the other investors that are ahead of it. So I really like this.
Yeah, and of course, like we believe that, there's a time and place for equity capital. And there's many opportunities that it would be better to go get equity. And there's absolutely nothing wrong with that. We just feel that if you have that flywheel, if you see that initiative that you're running, that go-to-market strategy, that sales team is really running well, invest in that. You don't need equity dollars to do that. You just need a different type of capital for a different period of time. And so there's lots of different ways you can do that. So jumping into the common questions that we see, I've got a poll here I'm going to launch. 3 questions. And for those of you on the call, if you want to just jump in and respond with what is most interesting to you. So on your screen right now, you should see 3 questions. What's on your mind? Is the difference between debt and equity something that you're most interested in? Or specific to TIMIA, like what type of companies we invest into? Or something personal about, or not personal, but relevant to your business, how much capital would you qualify for? So 3 questions there. I can see lots of answers coming in right now. The leading one, 63%, what type of companies do we lend to, is leading the way. So we'll give this 20 more seconds. Hey, can you see the results on your screen there?
Yep, I can see it.
All right. So
I love this question. Yeah,
ahead.
I'll feel free to sort of supplement whatever I comment here. But so the way I always answer this question is we invest in tech companies that are usually, I would say the vast majority is B2B SaaS, but it's quite a wide definition. And these days, in the early days of software, everyone was like pure software. Now hardly anyone is. So we have lots of combinations of companies that have a hardware component and they have software, or they have software, but they also have services that are in there, or there's a variable component to it. We also have some that don't have software, but there is reoccurring revenue that's in there. So it's quite a wide definition that we have. And if you are selling to the SMB space or mid-market or enterprise, we love that. We'll look at it. There's certain types of tech that we really like, and lots of lenders and VCs like that too, because of the size of the market and the stickiness and things like that. So, fintech and secure tech and medical, those sorts of things. So we'll do any of those types of technology across all different industries. We're not big on B2C. So, sometimes there's B to little b, or, there's a connection into a slight sort of consumer angle there, but just so everyone out there knows. But we will look at companies where you have, a tech-enabled company where you have reoccurring revenue. So you've got, a suite of clients, and they're coming back every month, every year, or, kind of on an ad hoc basis. And tying into that, what we will do is we will spend the time really understanding your business, and we will ask you lots of questions on your revenue streams and your pricing and your business model to get at that, because each of those different revenue streams will have a different multiple that we're going to provide to you. So it sort of starts to tie into the the aspect of how much will you qualify for. And of course, SaaS revenue is great because it's reoccurring and hopefully it's sticky. We'll we'll look at your customer concentration and all those sorts of things. But all to say, it's a pretty broad category. We don't do a lot of, like, if you're an e-commerce company, that's not in our wheelhouse. If you are selling direct to consumers, that's not in our wheelhouse. If you are doing services, we want to see that it's high margin. So generally, any company that we provide capital to that is in the services side, there's some kind of automation that they've put in there through sort of a tech-enabled, platform to make it so the provision of those services is efficient and effective, and they can set up quickly, and they're getting pretty good margins on that. I don't know if I covered that a lot. Anything I missed?
One thing I want to add to that, and one thing that really came clear to me about TIMIA, especially in the early days, was software as a service is actually it's actually really punishing to the founder in the early years, because what SaaS used to be was you went to like a Best Buy or Staples and you bought a box, right? You bought a box of software and you paid for it 100%. You went home and installed it. Or if you're a business, you let's say you bought SAP, you called SAP, they came to your place of business and installed a computer on your rack, but you didn't pay for 1 month. You paid for the entire rack. And so what software as a service has done is put the financing not on the software provider, right? So before, your customer would pay 100%. They would pay the lifetime value upfront. But now what it is you're like, oh, okay, I want that package, I want that piece of software, but I only want to pay for 1 month, or I only want to pay for 1 year. And so you don't know if initially, if they're going to stay for, let's say, 12 months, 24 months, 36 months. Maybe they'll sign a contract. So what's happened is the software provider is now a financier. You are now financing that lifetime value of a customer, right? And that like totally blew my mind, because it made a lot of sense to go to the store, buy a computer off the shelf, put it in your rack and start using it. You're paying, you get 100% of the LTV upfront. So now, if you are a founder of a SaaS company, you are financing all of your customers. So maybe they'll pay for a month, or maybe they'll pay for a year upfront, but you're not getting 100% of their lifetime value. So you have to figure out how much you can spend, how much can you invest to extract that lifetime value. I think that's where TIMIA actually fits in really, really well, because we're giving you that additional runway to access that LTV, and we're giving it to you a lot cheaper than equity. And so basically, once you get a flywheel running, that you have a marketing or sales or product initiative that's bringing you customers, you can grow that customer base for a lot cheaper.
Yeah.
And that's
the other
why
thing,
we invest in B2B SaaS companies.
Yeah. The other thing I want to add to that is it's really you sort of get mixed messages when you do a startup and you've got to invest all this money to actually build the software, and then eventually you got to find your product market fit and get out there. So when you're going to look at venture capital, they don't like you to have services, right? They want you just to be SaaS. But a lot of companies, and we get a lot of bootstrap companies, will have services in there because the services help to pay in those early days to keep the company and keep the cash flow going so that you can build the product and figure all of that out. So if you were to go to the market and talk to venture capitalists, you would get penalized for having services revenue there. And they'd be like, we don't like that and you need to get rid of it. For us, we actually like it because it shows you've been scrappy and you've gone out there and you've found a way to both build the software while managing your burn. And so we aren't going to penalize you for that. We're going to look at the software and we're going to look at the services revenue, and then we'll use that to, as Mark's saying, help you keep that flywheel going and get to that next stage.
Yeah,
So,
we can segment the different parts of revenue and give
yeah.
you give you benefit, give you kudos for the different segments of your revenue. All right, Monique, we got a great question here from Tim. He's asking, what if we look at the company and it's not a fit for TIMIA? What do we do?
Yeah, good. So we've got a huge network of partners that we work with that are all around the technology ecosystem. So if you are below our revenue threshold, and if you're in Canada, we try to, connect you with, hey, here, have you tapped into these different grants and other, providers that are there? If you're sort of above, so it's a whole, as I say, a whole continuum. If you're looking for a bigger facility than we can provide, we will connect you to another partner that will do that. Or if someone focuses in a certain sector, all those sorts of things. So and we try to do that with our portfolio companies too. So some of them will kind of outgrow us, or if they're looking for an exit as well and looking for some an equity round, we have a whole network and we try to connect them to organizations that are a good fit for them, based on geographically and which sector they're in and kind of what stage they're in. So we do our best to, to do that and try to find a way for you to get what you're needing at whatever stage you're at.
Yeah, Monique, this is a very, very small space, and we tend to see the same people or the same companies a lot. And everyone has, I guess what's difficult from an entrepreneur's perspective is every single company has their little tiny niche they want to invest in, right? And so there are dozens of companies, capital providers, that what we say are below us and above us. So we like to say we invest in companies between 2 and 20 million ARR. And there's definitely a ton of companies below us that are a really, really strong fit. And this is kind of leading into the next question here from Catherine, asking, who are we most comparable to? So there's a bunch of companies below us where, and I'll just look at this repayment waterfall again here. So if you're, let's say, under 2 million, it's probably going to be a little bit difficult to get that senior debt, right? So banks don't really want to look at a company that's doing less than 2 million of revenue, big banks. So that's where these guys come in. So your Pipe, your Clearco, your CapChase, FounderPath, ARC, I could go on. All of those guys, Lighter Capital, those guys play really well with the smaller companies. Now they're taking a little bit more risk, so they are a little bit more expensive than us. But depending on where your business is at and why you're using the capital, we have relationships with some of them, some players that are, let's say, quality players. I don't know how you want to call it, but good actors, people who are willing to fund a good business and do good deals. And we think that's really important, especially when we get a portfolio company. We want to do a good deal with a good business, be transparent. And then there's companies, let's say, like your Espresso Capitals of the world, where they do play in our space in that $2 to $20 million area, but they're focused on something a little bit different. So Espresso, as far as I know, now requires a guarantee, or a sponsor. So they are that venture debt provider. And there's lots of those, and they all, some of them might be looking at a specific industry, or a specific amount of growth rate, et cetera. So every company kind of has their thresholds, what they're looking for. And then, of course, above us, there's it's almost like a blue ocean, because they're, rather than just debt providers, there enters things like structured equity, private equity, growth equity, traditional venture capital, You know, you get some small regional players, you've got family offices. There's just a vast amount of players that will sit above us. And we have relationships with all of these because we like to help our portfolio companies, you know, get to where they're going. So as Monique mentioned here, we have helped our entrepreneurs, you know, move to the next stage. So we're very happy to get bought out of a company, and we're very proud to work with them when it was beneficial, but also understand that there's better deals out there for bigger companies. And so they move on to that next chapter, and we're very proud to be involved. Monique?
Yeah. Oh yeah, for sure. We can talk a lot about that. I just wanted to touch on the short-term loan aspect, because I think the difference between short-term loans and the sort of junior debt that we do, we're quite transparent. So some people will go, oh wow, look at those rates. We have pretty competitive rates for where the space that we operate in, and we're very transparent about the rates. And Mark mentioned earlier, like we'll show you what your payments are. It's not a floating rate, it's a fixed rate. So you can actually plan for what year 1, year 2, year 3 moving forward. Short-term loans, you really have to do your due diligence and really understand the product that you're getting into. So there's a lot of factoring, merchant advance that goes on in this space. So these shorter term loans, which, on face value, and they can be very, flexible and nimble if you're just doing it for 3 months or 6 months or whatever. But if you were to actually calculate the annual interest rate that you're paying on that, you'd probably be shocked on what it is. But because you're only paying it for 3 months and you look at the dollar value, you think, oh, maybe that's not bad. So, in certain circumstances, it can be a completely valid approach to take. But if you're, getting stuck in that and you're doing that over and over again, and constantly factoring everything, that cost is actually huge. And it's not apparent to people because it's the way it's packaged and the way it's presented. It's a little convoluted for you to sort of back out the math and actually see what's going on there. So I don't want to say it's, never an option, but really understand what it is that you're getting into, because also what happens is people just companies end up doing it over and over again. You think, oh, maybe I'm just going to use this to get through these next 6 months. And then the next thing you know, you're doing it all the time. And you would have been better going out and getting a term loan, to fund that. So.
Yeah, Monique, I think the best thing is, if you're not, so the way I look at it is, it's kind of like going to buy a car. You don't do it that often, right? And you walk into a dealership and you're like, oh, what are my options? But the problem is, the guys on the other side, the car dealerships, they sell cars every single day. So they know, right? They totally know how to make money. So you need someone who knows debt or equity, whatever. You need someone, when you're doing a capital raise, you need an advisor, whether that's your accountant, contract CFO, maybe you've got a very proficient VP finance. You need help. We highly, highly recommend, getting a couple term sheets, looking at the differences, looking at the gotchas, and finding the deal that's best for you. And that's what's really important. That's what we believe in. You need to find the right deal that works for your business at that time. So we are 40 minutes here. So why don't we do one more question and wrap up? How does that sound?
Yeah, sounds good.
All right. So I just threw together a poll here with a couple of questions we get often. So I'm going to throw this up. Couple questions here. So do we want to review the gotchas that we see a lot from what entrepreneurs tell us of what they've seen in term sheets? Our process, do you want us to discuss how we look at a company and what questions we ask and how we move through our process, or our loan structures? We can just talk about how we do deals, and what would that look like if you would take capital from TIMIA. So a couple people here in 75% say, what are the gotchas? So just leave this for 10 more seconds. Monique, do you want me to list out some of the gotchas that we hear about, and then you can pick one or two? How do you want to do this?
Yeah, sure. Yeah, whatever. We can go through it all. Yeah.
All right. So very quickly, I'm going to list some of them off, and whatever piques your interest that you think is key, jump in there. If someone else hears a gotcha that you really want us to cover, throw that in the Q&A. So this is what we see a lot of. If they want a piece of equity in the company, that might be real equity or it might be a warrant. So we can talk about those things. A board seat, a personal guarantee, a structure that may be a little bit different. So we used to do revenue-based financing, but now we do term loans. So what does that mean, a percentage of revenue? So we can talk about that. Fees are things that always come up. So for example, you might have an annual fee on your loan, or you might have an annual fee on the capital that you don't use. So you might have access to $2 million. You might have taken 1 million, but you have to pay a fee for the million that you haven't taken out. Maybe that's 1% on the outstanding amount, right? What's with that? So watch out for those things. What else? You can pay a fee on due diligence. So you pay a fee on legal. So you pay a fee. I can't remember what that one is called, so I'll skip to the next one. There's something called a DACA, which means the loan provider has like first pass on your bank account. So it's actually like their bank account, but you're putting money into it. We could talk about that. Prepayment fees, we could talk about that. That's what I was thinking of, prepayment fees.
Right.
So those are kind of the gotchas that we look at. Any of those stick out to you, Monique, that you want to cover?
Well, I think actually the guarantees is something to be aware of. So often we see people like in Canada, you have BDC that's up here, but if you have a senior lender and you're trying to get a line of credit or a term loan from a senior lender, and you're at that sort of lower revenue level of like 3 million or 2 million or below that, they're almost always going to ask for personal guarantees. And so, that means you're putting your personal finances at stake. You're putting, they'll usually ask for a couple founders. So we see that all the time. We don't take personal guarantees. So that's part of the benefit of what we do. And I think a lot of founders don't quite understand what they're signing up for when they do take a loan with those personal guarantees. So if you've done that in the past, it's okay, but try to graduate out of that. You should be able to negotiate out of that, whether it's a new lender or even with that existing lender, and ask them, what would you need? So even if it's a RBC or a CIBC or Avid Bank or whoever, what would you need to achieve to get out of that? Because you're taking enough risk as a founder and putting your whole heart and soul into building, this startup, and there's lots of sacrifices, and you take a lot of financial sacrifices at the start. You really shouldn't have to do that. So watch out for that. And if any lender who is asking for personal guarantees, you really just want to they'll have a GSA, so a guarantee on the business, which is all fine and fair if anything happens to the business. But as a founder, you should really protect yourself. So that's when I personally feel, with the empathy for the founders, is, really, really watch out for that one. And yeah, watch.
I couldn't agree more. If you're doing 2-3 million of ARR,
yeah,
lender shouldn't be asking for a personal guarantee.
Yeah,
that's a strong business. So
yeah, and sometimes it can just keep going through, right? So if you were in super early stages and you even get a $50,000 line of credit, and then it sort of ups, they just keep it there. Like you need to get out of that.
Yeah, don't negotiate out.
Yeah. Exactly. And the other thing is, like, it's different if you're doing a big VC round and, they're going to take a board seat. Really, really think about that, though. Know who you're getting into bed with, because, you're married to them. But it's the same thing for a lender. Like, so we don't take a board seat. We don't take warrants. We really want the founder to be able to put the gas on and go, and we trust them that they know how to run their business. So I would also watch out for that, because then all of a sudden you've got a monkey on your back. You've got someone who's like watching and really meddling and everything. So make sure if you are going to do that, put value to that. Because that's a big thing to concede from your startup, to sort of give away some of that control so directly, onto your board.
So to your point, Monique, one of the things that we see often in raising VC, and I'm just going to make one point, and then I'll throw you over to a blog post that we wrote about it: liquidation preferences. We see this in venture capital rounds often. VCs might squeak it in at the very last minute. So what liquidation preferences are, very quickly, is maybe it's 1x. That's typically fine. Once it's like 1.5 or 2x, then you're kind of in trouble. So what that means is, when there's an exit in the company, that VC gets access to the cash first. And then once that's done, then you split the remainder. And that can be really, really tricky. And again, I would encourage you to talk to a finance professional, like a contract CFO, or someone who does M&A. But if you want to learn more about that specifically, I would encourage you to go read our blog post, 14 terms that can ruin your startup. So if you go look at liquidation preferences, we've got a great little section of what that means. And of course, we're happy to jump on the phone and talk more about those things. So, Monique, with that being said, if there's an entrepreneur that's looking for debt capital from TIMIA Capital, where can they find us? Where can they find you?
Yeah. You can reach out by email and LinkedIn. You'll see on the website there, there's a button there that says Get Funded. You can just put in your basic information there and get the process started. So reach out to any of us. We're super responsive. We do have a process to go through, so we'll do it, and we don't want to waste your time, and you don't want to waste our time. So we'll go through initially and have a look at you and say, yeah, it looks like you qualify. Let's proceed through. And if you don't, we give you some feedback about why that is, that you maybe don't qualify. Come back in 6 months, come back in a year. We like to stay in touch and be able to watch and see how you're progressing and growing. And we will do our best to say, hey, consider these other options that are there for you. And then we've got a process to go through. So we try to make it as fast as possible, especially to apply in that first stage to sort of pre-qualify.
Yeah, I like to say that we say no early and often. So we don't want to waste anybody's time. We want to let you know if it's a fit or not as quickly as possible, with the least amount of information possible, and then get you on your way, get you to who is going to fit you the best.
Yeah. I might add to that. It sort of goes to one topic that we have, which is when you're going through the application process, keep in mind it's different when you're going to pitch a VC. So when you're pitching a VC, it's the hockey stick, it's the big, dream and where it's going to go, and everyone wants to be a unicorn, all that sort of stuff. It's completely different when you're coming to us. So we're really looking at your historical performance, and then we're looking especially at that first year of budgeting and what you think your sales are going to be, and especially the gap between your actuals and into your forecast. So is it reasonable? Does it make sense? Is there anything that's out of whack? Are you saying that you're going to go from 200 per month in ARR to all of a sudden 300 a month or two later? And we're like, okay, wait, how are you going to do that? That might fly when you're pitching VCs and they're like, hey, I like it to be aggressive. But for us, we really want to know that you're a good operator. and that you know the dials there that you can use on that flywheel to really set things going. So so keep that in mind. It's a much more realistic view, and like, well, we actually, it's a red flag for people who show growth too fast, because we're like, whoa, that's like, we're all about growth and we're here to fuel your growth, but we want to make sure that it's realistic and that your burn is able to be managed as you go along. So it's different. So don't send us your big pitch deck. If anything, it's send us your financials and your forecast. That's really what's going to talk to us, and we'll spend the time really understanding it and asking you questions and what's your rationale behind it, and we can actually provide quite a bit of advice and direction at that stage. And I actually find, coming from having been an advisor and an operator, and I'm very data driven. I'm often looking at their business models and going, hey, have you thought about doing this? Like, you could structure this so you've actually got, more SaaS revenue that's in here. And, I see you've got big setup charges. Like, have you ever thought about give that away for free, but build it into your SaaS? Those sorts of things. So we'll mention that, and we'll see where there's opportunity in your business model to maybe sort of tighten things up and set you up for the future. But yeah, just wanted to mention that. That's a big, you're not pitching us the dream, you're pitching us reality.
Well, Monique, it's been a pleasure. This has been a very fun exercise, and thanks everyone for jumping on to the webinar and asking questions. If you have anything else, I just put a link there to connect with Monique on LinkedIn. And of course, as Monique mentioned, just go to our website, hit the Get Funded button. We're happy to jump on a call and discuss your next financing. Monique, any last words?
No, thanks for organizing this. And yeah, we're an open book, and we're very accessible, and you can reach out to anyone, or anyone else will sort of jump in. We'll get to you in a timely fashion. We love to be a part of the ecosystem, and support our partners and all of the startup founders that are there. And as I said, I have great empathy for what all the startups are trying to do and the hard journey that they're on, and we're here to support you however we can, even if it's just connecting you through our network. So thanks for coming out and listening to us.
All right, everyone, enjoy your Wednesday and chat soon. Bye-bye.
Ciao.